So you've been doing the math in your head again. You're sitting there, maybe scrolling through Zillow at 11 o'clock at night, which honestly is basically a form of self-harm at this point, and you're looking at these houses, normal houses, not mansions, not penthouses, just houses with a yard and a garage and maybe a second bathroom so you're not arguing with your partner every morning. And the prices are just staring back at you like a personal insult. You think, okay, I make decent money, I have a job, I'm not blowing my entire paycheck on luxury vacations, so why does it feel like home ownership is this distant, almost fictional concept, something that happens to other people in other timelines where things somehow worked out differently? And here's the thing that really gets under your skin. Your parents bought their first home at like 26 on one income. Your dad was working a job that, adjusted for inflation, probably paid less than what you're making right now. And somehow they had a house, a car, maybe even a little savings account they were quietly proud of. You're sitting there, possibly with a graduate degree, definitely with more financial information available to you than any generation in history, and yet the math just doesn't work the same way. My name is Emmy, and I spend way too much time thinking about money, specifically about the gap between what people earn and what they can actually afford, and why that gap has started to feel less like a personal failure and more like a structural trap that nobody really warned you about. And today, I want to have a real, honest conversation about how much house your salary actually buys you. Not the optimistic version that mortgage calculators want you to believe, not the terrifying doomer version either, just the real version, with all the messy details, the hidden costs, the geographic realities, and the actual levers you can pull to change your situation. Because I think once you actually understand the full picture, something shifts. The anxiety doesn't disappear, but it gets replaced by something more useful: clarity. And clarity, weirdly, is one of the most underrated financial tools that exists. Let's get into it. The number everyone quotes and why it's almost useless. So, okay, you've probably heard the rule, the classic, everywhere you look, your uncle brings it up at Thanksgiving rule: spend no more than 2.5 to 3 times your annual salary on a home. So, if you make $80,000 a year, you should be looking at homes in the $200,000 to $240,000 range. Simple, right? Except when you actually go look at homes in that price range in most American cities, or in most major cities around the world, honestly, you quickly realize that rule was written in a different era for a different economy, and it has quietly become one of the most misleading pieces of conventional wisdom in personal finance. That multiplier rule came from a time when mortgage rates were somewhat predictable, when home prices relative to median income were significantly lower, and when the concept of a starter home actually meant something affordable. Today, the median home price in the United States hovers around $400,000. The median household income sits somewhere around $75,000. That's a ratio of about 5.3 to 1. Not 2.5, not 3. 5.3. And in cities like San Francisco, Los Angeles, New York, Seattle, we're talking ratios of 10, 12, sometimes 15 to 1, meaning someone making $100,000 a year is looking at homes that cost over $1 million in their city. That's not a personal finance problem, that's a structural economic reality that no amount of avocado toast cutting is going to solve. So when someone quotes you the 3 times salary rule and it makes you feel like you're somehow failing, I want you to gently set that rule aside because it was never designed for the market you're actually living in. The more useful question isn't, does my salary match the rule? The more useful question is, given my specific income, my specific location, and my specific financial situation, what does the math actually say? And that's where things get genuinely interesting. The real calculation: what banks think you can afford. Let's talk about how banks actually decide how much house you can buy, because the way banks think about this is both more nuanced and more revealing than most people realize. The number banks care about most is something called your debt-to-income ratio, or DTI. It sounds technical, but the concept is extremely simple. They take all your monthly debt payments, your future mortgage, your car loan, your student loans, your credit card minimums, and they divide that by your gross monthly income. The result is a percentage, and for most conventional loans, lenders want that percentage to be at or below 43%. The more conservative guideline says your housing costs alone should stay under 28% of your gross income. Let me make that concrete. Say you earn $75,000 a year. That's $6,250 per month before taxes. 28% of that is about $1,750. That's your theoretical maximum monthly housing payment, and that payment has to cover your mortgage principal and interest, your property taxes, and your homeowner's insurance. All of it, lumped together. Now, here's where people get tripped up. They see a monthly payment calculator, they type in a home price, and they look at the mortgage principal and interest number, and that number looks manageable. But they forget or don't realize that property taxes and insurance can add $300, $400, sometimes $500 or more to that monthly payment. And in some states, property taxes alone will genuinely shock you. So let's run the full numbers. You're earning $75,000, your max comfortable housing payment is around $1,750 all in. You've saved up a 20% down payment, which, sidebar, on a $300,000 home means you've somehow saved $60,000 in cash, which is its own entire challenge. With a 7% interest rate, which is roughly where rates have been sitting in recent years, a $240,000 loan carries a principal and interest payment of about $1,600. Add in taxes and insurance, and you're looking at maybe $2,000 to $2,200 a month total, which already pushes you past that comfortable threshold. This is why so many financially responsible people with good jobs, no frivolous spending, legitimate savings, still feel like they're barely squeezing into the housing market, because they basically are. The math is genuinely tight right now in a way it hasn't been for generations. The geography problem nobody talks about enough. Here is maybe the most important underappreciated variable in the entire home ownership equation. Your where you live matters more than almost anything else, like incomprehensibly more. The same salary, the exact same income, buys you radically different things depending on your zip code. And I don't just mean slightly different, I mean the difference between a comfortable 3-bedroom home with a backyard and a cramped 1-bedroom condo with a parking spot you share with 3 other people. Let me walk you through a real example. Say you earn $100,000 a year. In San Jose, California, that salary qualifies you, using standard lending guidelines, for a home around $400,000 to $450,000. The median home price in San Jose is well over $1 million. You are, in practical terms, largely priced out of any normal neighborhood. You're looking at long commutes, very small spaces, or the uncomfortable reality that your income, which sounds impressive, doesn't go very far there. Now, take that same $100,000 salary to Memphis, Tennessee, or Tulsa, Oklahoma, or Cleveland, Ohio. Suddenly, you're qualifying for a home in the $350,000 to $450,000 range, which in those markets puts you squarely in the really nice house category, like a house with multiple bedrooms, a proper kitchen, maybe a finished basement in a decent school district. The same income, the same person, a completely different life outcome based purely on geography. And here's the thing that really causes a lot of unnecessary shame and confusion online. You'll see people on financial forums saying things like, "I bought my house at 24. It's totally doable if you just budget properly." And other people responding with, "That's literally impossible. Home prices are insane." And here's the thing. They're both right. They're just talking about 2 different housing markets that happen to exist within the same country. The down payment mountain. Okay, let's talk about the part that stops most people before they even get started, the down payment. Conventional wisdom says 20%, and that 20% number is worth understanding because it's not arbitrary. When you put down 20%, you avoid something called private mortgage insurance, or PMI, which is a monthly fee, sometimes $150, sometimes $300 or more per month, that protects the lender, not you, against the risk that you might default. PMI disappears once you've built enough equity in the home, but in the early years of your mortgage, it's just extra money leaving your pocket every month for no direct benefit to you. So yes, 20% is ideal, but on a $300,000 home, 20% is $60,000. On a $400,000 home, it's $80,000. These are not small numbers. These are numbers that take most people years, sometimes a decade, to accumulate, especially while also paying rent that eats 30 to 40% of your income. And here's the quiet irony that makes this genuinely maddening. The people who most need housing stability, people who are tired of moving every time a landlord raises rent or sells the building, people with kids who need a consistent school, those people are often in the exact economic position where saving $60,000 or $80,000 while paying high rent is an enormous, slow, grinding challenge. There are alternatives to 20%, though, and I think more people should know them concretely. FHA loans allow down payments as low as 3.5%. On a $300,000 home, that's $10,500. Still not nothing, but dramatically more achievable for most working people. The trade-off is that you'll pay mortgage insurance, you'll have a slightly different loan structure, and your overall borrowing costs over time are higher. But for someone who has a stable income and wants to stop renting, it can be a legitimate path. Conventional loans also now commonly allow 3 to 5% down, and many states have first-time home buyer programs with down payment assistance, sometimes grants, sometimes low-interest loans, that can significantly close that gap. The frustrating thing is these programs are underutilized because people either don't know they exist or assume they won't qualify. Looking up what's available in your specific state takes about 45 minutes and could potentially change your timeline by years. One more thing on down payments that I think is psychologically important. The 20% goal can sometimes become a moving target that quietly destroys your motivation. You're saving for the down payment, home prices keep rising, and suddenly the 20% you're chasing is bigger than it was when you started. This is demoralizing in a very specific way. If you find yourself in that loop, it's worth genuinely asking whether waiting for 20% makes more sense than getting in with a smaller down payment sooner. Because in a market where home values tend to appreciate, the cost of waiting is real and often underestimated. What the monthly payment actually includes. This section is honestly one of the most practically useful things I can walk you through, because most people, when they're dreaming about buying a house, when they're running numbers on their phone at midnight, they're only thinking about one or two of the costs involved, and a full picture is genuinely more complicated. Your monthly housing cost has layers. There's the principal, the portion of your payment that actually reduces what you owe on the loan. There's the interest, the cost of borrowing, which in the early years of your mortgage makes up the overwhelming majority of your payment. This surprises people every time. If you take out a $300,000 loan at a 7% interest rate, your first monthly payment is going to be around $2,000. Of that $2,000, roughly $1,750 is interest, and maybe $250 is actually paying down your loan balance. That ratio gradually shifts over time, but in the early years, you're essentially just servicing the interest. Then there's property tax. This one varies so wildly by location that it's almost hard to generalize, but in many parts of the United States, property taxes run between 1 and 2% of your home's assessed value per year. On a $300,000 home, that's $3,000 to $6,000 annually, $250 to $500 a month added to your payment. Homeowners insurance is usually more manageable, somewhere between $100 and $200 a month for a typical single-family home, though if you're in a flood zone or an area with high weather risk, it can be significantly more. And speaking of flood zones, flood insurance is an entirely separate policy that your regular homeowner's insurance doesn't cover. A lot of buyers discover this late in the process. Don't be that person. If you buy in a community with a homeowners association, which many new developments and condos have, add your HOA fees on top of everything else. These range from $30 a month in some neighborhoods to over $1,000 a month in some urban condo buildings. HOA fees also have a habit of increasing over time. And then there's maintenance. The general guideline is to budget 1 to 2% of your home's value annually for upkeep: the roof, the HVAC system, the water heater, the thing in the backyard that stops working right before you have guests. A $300,000 home could need $3,000 to $6,000 a year in maintenance costs on average, though of course it's lumpy. Some years nothing breaks, some years everything breaks at once in what feels like a coordinated attack. Add all of this up, and you start to see why the monthly payment number that shows up in online calculators is genuinely, sometimes significantly, misleading. The real cost of owning a home is typically 15 to 25% higher than just the principal and interest payment. Anyone who hasn't done that full calculation before buying is in for a surprise. The interest rate problem, and why timing matters more than people admit. Let's talk about something that has probably done more to reshape housing affordability over the last few years than almost anything else: interest rates. This might seem like dry financial stuff, but I promise it has a very human story attached to it. For most of the 2010s and into the early 2020s, mortgage rates sat at genuinely historic lows. We're talking 3%, even 2.5% at the bottom. At those rates, a $300,000 loan cost about $1,270 a month in principal and interest. People were buying homes at these rates and locking in extraordinarily low monthly payments for 30 years. Then rates climbed quickly. By 2023 and into the recent period, rates had moved to the 6, 7, even 8% range. At 7%, that same $300,000 loan now costs about $1,996 a month. That's roughly $700 more per month, every month, for 30 years. The same loan, the same house, $700 extra every single month because of when you happen to be ready to buy. This is not a personal finance failure. This is just timing, which is partly luck and partly circumstance. And I think a lot of people who are frustrated right now, people who feel like they did everything right and the market still punished them, are dealing with exactly this. They graduated, they got their jobs, they saved their down payments, and they showed up to the housing market at one of the most difficult entry points in decades. The counterpoint, and this is worth holding on to, is that interest rates can be refinanced. If you buy at 7% today and rates drop to 5% in a few years, you can refinance and capture those savings. You can't go back and buy a house at last year's lower prices if you waited. So there's a real argument for buying within your means now, even at higher rates, and refinancing later when conditions improve. It's a bet on the future of rates, and it doesn't always work out, but it's a more nuanced calculation than just rates are high, don't buy. The salary ranges and what they realistically buy you. Okay, let's get into something concrete. What does a particular salary actually buy you right now in practical terms? If you're earning somewhere in the $50,000 to $65,000 range, you're looking at a maximum comfortable purchase price using standard lending guidelines and assuming a 5% down payment of roughly $180,000 to $240,000. In a lot of major metro areas, that range gets you very little. A small condo in a suburban location, maybe. But in secondary and tertiary markets, think mid-sized cities in the Midwest, the South, South, parts of the Mountain West, that range can still get you a legitimate starter home, not your dream home, but something livable, something yours, something that builds equity. In the $75,000 to $90,000 range, you're working with a purchase price somewhere around $250,000 to $320,000. Again, in expensive coastal markets, this is still very challenging, but in most of the American interior, this is a genuinely solid range. You have options. You're looking at decent homes in decent neighborhoods. At $100,000 and above, the picture shifts more meaningfully. Somewhere between $320,000 and $400,000 in purchase price is what the math typically supports. In expensive cities, you're still constrained, but not completely locked out. In mid-cost markets, you're looking at quite nice homes. In low-cost markets, you might be able to buy something genuinely impressive. Dual income households, and this is significant, change everything. Two people each earning $65,000 is a combined income of $130,000. The math on that looks a lot different. The down payment becomes more achievable because there are two people saving. The monthly payment is shared. The qualifying loan amount is larger. This is one of the underappreciated reasons why homeownership rates tend to be significantly higher among partnered couples than among single people, and it points to a real equity issue in the housing market that doesn't get discussed enough.
There's one more layer of cost that catches first-time buyers completely off guard, and I want to spend a moment here because it has derailed more than a few people at the finish line. Closing costs. When you buy a home, in addition to your down payment, you pay a collection of fees to actually close the transaction. These include loan origination fees, title insurance, escrow fees, appraisal costs, attorney fees depending on your state, prepaid taxes and insurance, and various other line items that add up with remarkable efficiency. The total is typically between 2 and 5% of the loan amount. On a $300,000 home, closing costs might run $6,000 to $15,000 on top of your down payment. So if you saved up $15,000 for a 5% down payment, you might need an additional $8,000 to $10,000 to actually close the deal. This surprises people in a way that is frankly unnecessary. It shouldn't be a surprise, but it often is, because nobody sits you down in school and walks through the full financial anatomy of a home purchase. And then once you're in the house, there are the immediate setup costs, moving expenses, maybe new appliances because the ones in the house were older than you realized, maybe a lawnmower because there's now a lawn. Little things that add up to several $1,000s in the first few months, at the exact moment when your cash reserves are depleted from the purchase itself. It's a financially vulnerable moment, and having a cushion on top of your down payment and closing costs isn't optional, it's genuinely important. The levers you can actually pull. So we've spent a lot of time looking at how the numbers work, and let's be honest, some of it is genuinely discouraging. But I want to spend time here on something that I think matters a lot, the levers that are actually within your control. Because the narrative that home ownership is simply inaccessible for most people isn't entirely accurate, even though I understand why it feels that way. There are real decisions, real trade-offs, real strategies that move the needle. The most powerful lever, and I know I've touched on it, but it deserves direct attention, is geography. If you're living in a high-cost city primarily out of inertia, or because that's where you grew up, or because you haven't seriously interrogated whether you need to be there, that question is worth asking seriously. The financial difference between living in a high-cost metro and a mid-cost metro on the same income can amount to millions of dollars over a working lifetime, not thousands, millions. In home equity, in savings rate, in overall financial stability. The second lever is income growth, which sounds obvious but is worth naming specifically. The housing market feels more manageable at $120,000 than it does at $75,000. Strategies that accelerate income, a second skill, a higher paying role, a side income that becomes a real income, directly expand what the math allows. The third lever is the down payment strategy. If you're currently renting and can find ways to meaningfully accelerate your down payment savings, whether through temporarily reducing other spending, redirecting a bonus, getting help from family, or using a down payment assistance program, the compounding effect of getting into a home sooner in an appreciating market can be substantial. And the fourth lever, which people underutilize, is negotiating the purchase itself. In markets where homes are sitting longer, where sellers are motivated, where you have time and patience, buyers have more power than many realize. Getting a seller to contribute to closing costs, negotiating the price down, asking for repairs, these aren't aggressive moves. They're normal parts of the transaction that are worth pursuing. So, wrapping this all up, here's where we've landed after all of this. The idea that a simple salary multiplier tells you what you can afford is outdated, and letting go of it is actually liberating. The real calculation is more specific, more contextual, and more nuanced. It involves your income, yes, but also your location, your interest rate, your down payment size, your other debts, your local tax rates, and a collection of costs that most people haven't fully mapped out before they start looking. The housing market is objectively harder right now than it was for previous generations. That's not a victim mentality. That's a documented economic reality. Price-to-income ratios are at or near historic highs in most major markets. Interest rates, while off their recent peaks, are significantly higher than the historically low rates that defined the prior decade. The gap between renting and owning has narrowed in many markets in ways that complicate the old conventional wisdom. And yet, people are still buying homes. People are finding paths through geography, through patience, through creative financing, through income growth, through genuine financial discipline to get there. Not everyone, and not easily, but it's happening. And the people who get there are almost always the people who stopped consuming the generic advice and started getting specific about their own numbers, their own market, their own realistic options. The thing I want to leave you with is this: understanding what the math actually says, not the optimistic calculator version, not the doom-scrolling version, but the real, complete, fully loaded number is not depressing. It's empowering. Because when you know exactly what you're working with, you can make a real plan. You can look at your salary and say, okay, in my city, this buys me this. To buy what I actually want, I need this number. To get to that number, here's what changes. That's a solvable problem. That's a path. And a path, even a long one, is infinitely better than just staring at Zillow at 11 p.m., wondering why nothing makes sense. You've got more agency here than it feels like in the dark moments. The numbers are real, the constraints are real, but so are the possibilities. Start with the real numbers. Build from there.